The Fed just crashed the Bitcoin shares. Not only Bitcoin, but everything, right? The market just didn't like what the Fed did last night, and we will dive into all the details that you maybe have missed and what's important to see now.
Welcome to the game, I'm the Wolf of Dubai.
Welcome to a brand new video. If you don't know who I am, my name is Danny and I'm the biggest BMNR show on the whole internet. And you should be subscribed to all of my channels on my X account and my colleague who's talking about HIMS with his HIM show, Michele X10 Stocks. Just follow both of his channels because he just, predicted the short squeeze on HIMS that did like 80% in 1 week, which was absolutely insane. We benefited tremendously on that and you should be part of that. Also, don't forget to check out x10daytrading.com. We have only 10 days left before we're raising our joining fee. And this week, it was a very choppy week. Sometimes there's weeks that nothing happens, okay? The market goes down and up and just like it's very choppy. However, we did 100% on our trades win rate. Again, we are now 93% win rate for the whole month. Pretty good again. And if this is interesting, all done for you with our software that we control. We send out the trades. The professional day trading team makes all the decision. The buying and the selling is done inside your portfolio all automatically. Check it out before we raise our joining fee. Now, let's talk about the Fed, okay? The Fed comes out every month approximately. Some months they don't come out. They have like a 1 or 2 months breaks. But usually they come out and say, listen, guys, we believe that's the economy, that's the inflation, that's the job market. We will raise or reduce the rates. Based on that, obviously companies, can take more money and invest because the rates are lower and therefore also people buy more houses, for example, right? So the economy can be stimulated. But what the Fed is afraid of, Cordy, and there's like a big discrepancy between Trump and Jerome Powell, where essentially Trump wants the economy to go higher and the stock market to go higher. And that's only possible when the rates are lower. On the Powell side, he says like, guys, listen, the inflation just came down. Then there's the war and so on. We are so much in uncertainty that we don't want to make the money cheaper. Okay, so we think it's a very good place. Well, that's exactly the thing, right? So let's dive into the first clip that I have prepared for you, which is essentially my colleague, Meet Kevin, who makes great summaries of the Fed every single time. Let's have a look.
Jerome Powell just gave us his press conference. Rates remain unchanged, and he gave us a beautiful, delicious summary of economic projections that didn't imply rate hikes, that implied GDP growth, and that implied a stable unemployment rate. And then Jerome Powell had to come out during the meeting and say, never mind that. We actually almost skipped doing his summary of economic projections because we literally have no idea. And instead, we talked about rate hikes. Yeah, boy, oh boy, we got a lot to break down in this one because our expectations got turned on the head of what we thought. First, let's start with that summary of economic projections. What we were looking for in the summary of economic projections was a projection of under 3.6 for the Fed funds rate. We got that. We got no movement here in the median. 3.6, 3.6, 3.6, 3.5. Perfect. Great. Then they even wrote up GDP. They brought GDP up 1/10 this year, up 3/10 next year, up 2/10 next year. This was a beautiful summary of economic projections. Everything about the summary was great. No stagflation here, a little bit of inflation, not a lot though. They only moved up the projection from 2.5 to 2.7 over here on core, or 2.4 to 2.7 on PCE. I thought markets would even be okay with going all the way up to 3% here because of the Iran shock. So overall, the summary of economic projection seemed fantastic. This was really good. Now, one thing that was bearish was in the actual statement, they did mention that they removed the employment and the labor market has shown some signs of stabilization, and they changed that to the labor market is little changed. That was a little bit disappointing to see. It wasn't part of the summary of economic projections, but it was part of their statement. Waller ended up moving from cut to hold, and so we got 11 votes to hold and 1 vote, that was Stephen Myron, for a 25 basis point cut. So far, Kevin Warsh only has one friend. If, of course, he takes over, because there's always the chance that Jerome Powell stays, which he also implied that he might stay. More on that and the mechanics of that in just a moment, which means we would probably delay rate cuts even more.
So, beside this clip, I prepared another clip which is very, very important, okay? So, first of all, the good thing. Let's talk about the good thing about this Fed conference and what this means for Bitcoin. First, they don't seem to raise the interest rates, which is bullish, right? Like, it doesn't get worse than raising the rates, right, in this environment. Second, they believe that there is one rate still appropriate for this year. The market currently prices in 0 cuts, which then makes me wonder, is this again bullish because everyone thinks that there's no cuts? And remember, the new Fed chair is coming in May, who's more about cutting rates. So he maybe cuts, 2 or 3 times in this year. So we will see, like the Fed chair, it doesn't have the decision. They have to make it all in the committee. But the chairman can always influence, right, where the Fed is going, right? So with that said, let's dive into the second clip by Jerome Powell himself. And he shows us a little bit, which is very important, the plot. Okay, so let's have a look into that.
In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Colby. Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind. And the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
So as you can see, the plot plan is usually how every member in the Fed is deciding. Some members say like, I don't see 2 rate cuts this year. So, they set their dots. And then you can see according to the dots, actually the rate cuts were lower than expected, right? So the people rather hope that maybe we get 1 or 2 cuts this year and then maybe another 1 or 2 the next year. But it seems to be the Fed is more cautious, and that's obviously hurting specifically the risk on assets. Now let's turn the point to BMNR. If you check what happened, BMNR is down another 3% from yesterday's 7, right? So we lost about 11% just in the last couple of trading hours since the Fed is there, okay? So the question will be, is this something that the market actually now uses to sell a little bit more? Because the only issue that I have with the markets right now is the following, okay? And let me show it to you. The problem that I have in the market, okay, let's say the S&P 500, we are just down 5.5%, okay? While it doesn't create such a big problem, it's something to consider. Like the market could go down for 10, 20% and take crypto with them. But usually crypto is a forward-looking indicator for the market. So actually, while the market can go down on the way in the process, maybe crypto recovers, right? So that will be now very, very, very interesting for the market if we hold there. What would be very bearish is when we close the week below 590 in the QQQ, in the NASDAQ, okay? That would be not so bullish for the market and more downside could come. But you can see here the dilemma. We just broke, through this beautiful channel above like 22 and hold it there for a couple of days just to bring it down. And I get the frustration, but believe me, if you are a long-term investor, if you truly are, then those are the gifts that maybe stop be given at the end of this year or actually by the next couple of 2 months. So if this is interesting, make sure to subscribe. Check out xnDayTrading.com if you want us to trade for you before we're raising our joining fee. And I see you obviously tomorrow for a brand new video because the grass is greener always on the other side.